Welcome to Retire Smart Maryland. My name is Cynthia Defazio, and I'm joined today by Prashant Sabapathi and Nick Innerbichler of Elite Income Advisors. Prashant, good morning. It's so good to see you.
Good morning. It's nice to see you as well.
Thank you so much. Nick, how are you today?
I'm doing great, Cynthia. How about you?
Doing great. Thank you so much. You both are always smiling, and you bring so much energy to the set. I don't know how you do that, because I know you've been so busy. You've been traveling, you've been seeing clients, booking consultations right and left, and yet you show up here every week and you're just full of energy. So what are you doing? Vitamins? What's going on?
Got to try to stay healthy where we can, right?
Absolutely.
So we like to get out and play some golf for light exercise. And,
yeah.
You know, it really feels like when we meet with folks and we're able to help them, I know it's kind of like a cliche, but it doesn't feel like we're working all that hard, especially when you know that you're making a difference in somebody's family's life. It's very fulfilling for us. And so, yeah, we do work a lot, but a lot of times it doesn't really feel like it.
Because you genuinely care about people.
Yeah, when you love what you do, it helps you get up every morning and get into the office so you can see, you know, who are you going to get to see next and what kind of situations are going to be able to help them with. It's a great feeling.
Absolutely. And let's talk a little bit about that for just a moment. What does it feel like right now for someone coming into the office? We're obviously still following the CDC guidelines, correct, Prashant?
Yep, 100% in compliance with CDC guidelines. So you come in, you're greeted in our kind of client lobby and you know, offered a beverage and everything. But when you come in to see us and sit down with us, everyone's got a mask on. Our staff, you know, we have some of them working off hours or remote so that we can keep our office as socially distant as possible. Our meeting rooms are sanitized after each and every use. Everybody's wearing a mask. We offer a mask to anyone who doesn't have one when they come in. But really, when you get to sit down with Nick or myself or one of our other team members, we're really just there to get to know you.
Sure.
Figure out really what is important to you and what you want your life to look like. And once we have a good understanding of that, we can help you put a plan together to see whether or not you are on track to have the retirement that you kind of deserve.
Okay.
And so that's how we're able to help people.
Absolutely. Well, I love today's show, Nick, because obviously these are all viewer questions that we've been able to glean through the weeks, Prashant, as well. And I love this because it's a mixed bag, really. We have a lot of different topics that we've covered throughout the weeks that we've been together. So the questions today are going to kind of encapsulate all of that. So to the viewers at home, these questions are actually your questions. So please, you don't want to go anywhere. This show is all about you. So Prashant, I'm going to throw the first question at you.
Let's do it.
We have a caller actually from Clarksville. He wants to know, Prashant, should people consider using life insurance to build tax-free cash value? What is your opinion?
So I think it's important to be well diversified, right? And oftentimes we think of diversification with sole regard to our investments. Maybe it's having a balance of stocks and bonds. But when I think about diversification, I do think about that. But what I also think about is a diversification of tax markets. I don't want to have all of my money in a 401k or an IRA where every time I take money out, it's fully taxable. I don't want to have all my money in taxable accounts where I'm always paying taxes on my growth. And so one big bucket that we're a big proponent of is the tax-free bucket. Believe it or not, if you structure your life insurance the correct way, it can actually act almost like a Roth IRA, in which case all your distributions have the capability of being tax-free to you. And so life insurance can be a great way to do that if you've done it correctly and you work with a fiduciary and a professional who's well-versed in it.
Okay.
And so short answer, yes, but make sure it's done the correct way.
Okay. Thank you, Prashant. Nick, we actually have a caller from Ellicott City. Their question to you is, Nick, is it difficult to do a Roth conversion on an IRA?
Right. Great question. We hear it quite frequently, maybe not as much as we'd like to see it or talk about it, but short and sweet, it's not difficult to do. If you do it the right way, it's very simple. But the thing that you have to consider, and a lot of people don't understand this, is that a Roth conversion is simply taking pre-tax money, an IRA, paying the taxes on it today so that you have tax-free distributions in the future.
Excuse me.
you want to make sure that it makes sense, that it's not going to put you into a higher tax bracket. You want to make sure that you have the cash on hand potentially to pay the taxes on that conversion. But it's a fairly simple process, and it's just taking it from one company, moving it to another, filling out a few forms. So it's very simple, but it has to be right, and it's not always the right thing. You have to have a certain time frame in which to recoup the taxable event. But we do love to see Roth IRAs in our clients' portfolio, because there's fewer and fewer ways to receive tax-free income. And if you have more tax-free income in your retirement, then you're going to actually see your dollar go a lot further.
Okay, thank you, Nick. Excellent answer. Prashant, we have a caller actually from Annapolis. They would like to know this. What is the #1 strategy anyone can use to lower taxes?
Wow, loaded question there.
That's a great one, right? #1 strategy.
Yeah, and I'm going to kind of piggyback on what Nick said, and really what I said in the beginning, which is we want to be well diversified. So Roth conversions, we're seeing a lot more of this. Maybe you have access to something like a Roth 401k at work, right? More employers are offering a Roth 401k where all your money goes in after taxes, but all of the growth that it gets over the years is actually tax deferred. And then when you take withdrawals, it's actually tax free.
Excellent.
And so, look, at some point you're going to pay the taxes. It's just a matter of, are we going to pay them now when they're relatively low and let them grow tax deferred and withdraw tax free, or are we going to pay them later?
Okay.
And so this always is going to come back to, where do we think tax rates are going to go? And I think the general consensus is they're probably going to have to go up.
Probably going to go up, yeah.
And so there's not one magic way to do it, but you know, Roth accounts, IRAs, and 401ks are a great place to start.
Excellent.
If I can add, it's one thing that we don't see enough of, as I said. Roth IRAs are still, and Roth 401ks are even newer, but they're still a fairly new investment vehicle, so to speak. And not a lot of people take advantage of them when they should, whether it's contributing annually to a Roth IRA or contributing to a Roth 401k with your employer. I'm young, right? And 401ks may not be the best thing for me. I need to put the money in pre-tax, which is great. It reduces my taxable income, but I'm going to pay the taxes when I retire. So I try to put as much money away into Roth IRAs and Roth 401k. I just switched recently in the last year. I do half and half. Half of my contributions to my 401k are Roth, and half of them are traditional pre-tax contributions. So I'm trying to build up that tax-free pile of money when I retire, and we'd like to see more people doing that.
I think that makes perfect sense. That's a great idea and a great plan, Nick.
Yeah.
This is why you do what you do.
Yeah, absolutely.
I love it. Prashant, this is the perfect time for us to open up the phone lines to the viewing audience at home this week. Can you tell them what they can expect to receive by calling in?
Sure. So when you call in, you'll be able to book an appointment to visit our office and meet with Nick and myself. We have 2 offices conveniently located in Columbia and Annapolis. And so dial the phone number. It's 833-308-5200 and schedule that time to meet with us. And when we sit down, it's all about you. You'll get a chance to kind of see if we're a good fit for you, and we'll get a chance to get to know you and learn what you want your retirement to look like. And from there, we'll schedule you for a series of meetings where we can show you where you stand today and what you need to do to make sure that you are on track for the retirement that you deserve. So please give us a call. It's 833-308-5200, and it's for this week, it's only open to the first 10 callers. And then, you know, you'll have to try again next week. So first 10 callers, give us a shout.
Thank you, Prashant. Thank you, Nick. To the viewers at home, the phone lines are now open. And like Prashant said, we only have 10 spots available this week. The number to call is 833-308-5200. We have to take a very short commercial break, but when we come back, we're going to have more of your viewer questions. So you don't want to miss the answers. Please stay tuned.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only. to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to Retire Smart Maryland. My name is Cynthia Defazio, and I'm joined today by Prashant Sabapathi and Nick Innerbichler of Elite Income Advisors. Gentlemen, a great show. Obviously, all viewer questions, and we have so many different topics that it's very interesting to see where they're coming from. Nick, we have a caller actually that called in from, do I say that, Catonsville?
Yep.
Catonsville, okay, perfect. It says, Nick, can you explain exactly what is a retirement income gap?
Great. Retirement income gap, that's a great question. So when we sit down and plan with our clients, right, we're evaluating all of the different sources that they have. And there might be pension, their Social Security typically, right? And then there might be no retirement accounts. There might be no IRAs or anything like that. So, but we're trying to put together that plan and looking at each piece of the puzzle. And in some cases, there are missing pieces. And a retirement income gap is not accounting for some big part of that. And so we want to sit down and evaluate that ahead of time. And you might have IRAs. You're not sure exactly how much you can earn off of them, how much you can distribute to yourself. But we want to fill that hole and make sure we account for whatever it might be. What is that gap that you're not accounting for? Is it more fun things? Is it medical expenses, etc.?
Really, the gap is simply just the difference between the safe and secure income that you can always depend on and what you feel your expenditures are going to be. If I need $8,000 a month every single month to be really comfortable in retirement, but my pension and Social Security's only add up to $6,000, well, then I have a gap of $2,000. Right. And that's how we can, from there, we can help you figure out how to close that gap.
Okay.
And that's really what we specialize in.
Thank you, Prashant. We have a caller from Clarksville, actually, and they would like to know, Prashant, when should someone consider a trust, and what does it provide?
Trusts are great from the standpoint that we always like to say they give you complete control of your assets even after you're gone. So with a trust, you can make it as simple or as complex as you would like it to be. A great place for people to start is making sure that the beneficiaries listed on every single one of your accounts is up to date. And when we have situations where maybe there's special needs involved and we want to protect government benefits in that case, or if we have a case where you want to have very specific control of how your assets are distributed, getting involved with a trust may be a good idea. In terms of how you know you need one, you can meet with any kind of estate planning professional, which we have great partnerships that we can set you up with an estate planner, and they'll help you develop an idea of whether or not a trust is right for you. There's sometimes, even in cases where people have a large retirement portfolio where a trust is not necessary, we have cases where there's smaller retirement portfolios where a trust is absolutely necessary. So I don't want to classify by saying if you have a certain amount of money, then you should have a trust. It's all dependent, just like your financial plan, it's really dependent on your unique situation, whether or not you need a trust.
And if I can add on to that, something that Prashant just glazed over a little bit, but beneficiaries. We haven't talked about those a lot in the past, but if you have a trust and you don't name your trust as your beneficiary, then you didn't do the whole thing, right? So every investment account that we have, an IRA, a 401k, a bank account, has the ability to add on some type of beneficiary. And if you don't change your beneficiary at the time you establish your trust and you die, then however you had it set up previously is going to be who receives those funds. And the Supreme Court actually ruled on that unanimously. That never happens, right? But they unanimously ruled that that the beneficiary form that you fill out, whether it's with your custodian on your IRA, whether it's at the bank, whether it's with your employer, that person or persons or entity that is named takes precedence in any other wishes that you have.
Wow.
So it's very important. If you were previously married, you don't want your ex-wife getting your money when you're now married to somebody else. So we've seen things like that. Those are things that exist. But if you're taking the time to put together a trust, go all the way. Make sure that if your trust is intended to be your beneficiary, update that form.
Okay, very good advice. Thank you, Nick. Nick, we have another caller actually from Annapolis, and they would like to know, what is the best way for someone to diversify their risk and reduce volatility when you're speaking of portfolios?
Sure. Well, the biggest way to do that, of course, is we talked about, is your age the right thing to determine your risk on. Diversifying just means spreading your investment, moving the risk and spreading it out among all the different options that you have. Is it bonds? Is it stocks? Is it gold? Is it real estate? And picking those investments that are going to allow you to take the amount of risk or downside loss that you're comfortable with. And we've talked about this before. We look at it very differently, right? We want our clients to know how their portfolio is going to behave when the market goes crazy, as we like to talk about. If the market goes down 30% and you're not comfortable with that, well, then you need to make sure your assets that you've invested in are set up properly so you don't lose 30 to 40 to 50%.
Excellent. Thank you so much. Prashant, we have a caller actually from Clarksville.
Okay.
They would like to know, what are the most important things that I can do, Prashant, when planning to take Social Security? That's a great question.
It is. It's one of the more common questions that we get, right? And so the first thing that you have to have, really the most important thing that you have to have when you go into the Social Security office to file for your benefits is confidence. You have to have the confidence that you're making the right decisions, because they don't give you too many do-overs. And so you got to make sure that you're making the right decision. So how do you go about being confident in the decision you make? You have to understand what the differential is between, let's say, the best available option and the worst available option. I want to know how much money or income I'm leaving on the table between the different decisions that I have. And so one of the things that we do, really for anybody who wants to call in, is we'll do, we call it a Social Security timing report. Timing report, believe it or not, will go through every single available strategy for how you can collect your benefits, and it will assign a lifetime income to that strategy. So you can actually see a quantifiable number, what the differential is between the best available strategy and the worst available strategy. And that is a great starting point to give you all the confidence you need to make sure that you're making the right decision when you file for your Social Security benefits.
Prashant, thank you so much. And this is the perfect time for us to go ahead and open up the phone lines to the viewers at home one more time. Would you like to tell them what they can receive?
Sure. So first thing is that Social Security timing report. I just talked about it. If you want your customized, personalized Social Security timing report, give us a shout. It's 833-308-5200. But in addition to that, we'll get to know you and we'll help you get on track for making sure that your retirement income is going to be taken care of, to make sure that you've addressed any of those income gaps that we talked about. We'll also take a look at your investments to make sure that your risk is appropriate for your retirement plan. So it's open to the first 10 callers. Phone number is 833-308-5200. Give us a call and schedule a time to come see us.
Prashant, thank you. Nick, thank you so much. To the viewers at home, the phone lines are once again now open. And as Prashant mentioned, there's only 10 spots available each week because they're so busy. They can't really take any more clients than that. So please don't miss the opportunity to call. The number is 833-308-5200. Remember, viewers, this is your show today. So when we come back from the commercial break, I'm going to have more of your viewer questions. Prashant and Nick will have the answers for you. Please stay tuned. We'll be right back momentarily.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retire Smart Maryland. My name is Cynthia Defazio, and I'm joined today by Prashant Sabapathi and Nick Innerbichler of Elite Income Advisors. Great show today, gentlemen. Obviously, all viewer questions, so I don't want to miss a beat. I'm just going to keep going, Nick, and this next question is for you, and it's actually from Elk Ridge.
Okay.
It says, Nick, what do you suggest people do when they have investments that lose money? Do they panic, review the plans, stay the course, or maybe just ignore all the noise?
Wow, that's a lot of a question there. So I think human nature is when things like that happened, and we've had over the last 20 years, we've had 3 significant market events. We had the tech bubble, we had the financial crisis, and we had the COVID crisis or bubble. The good news is that after COVID initially hit the scene, the market recovered very quickly. But we were just meeting with some people a few weeks ago, and they made the decision, maybe around the time that the COVID crisis started, to pull their money out of the market. And timing couldn't have been worse necessarily, but maybe they didn't lose as much as they would have as if they were invested during that period of time. But they don't know the right time to get back in, right?
Sure.
So human emotion, fear sets in some cases, and you don't know when to enter back into the market. So everything goes back for us to having a solid plan. And if you've sat down and you've planned this out over the last several years, then something like that, when a big market event occurs, if you've sat down and taken the time with us to evaluate your portfolio, figured out how much loss you can incur, then you're going to be okay, and you won't have to worry about those things. So it just depends, but again, it's a human reaction to an adverse condition.
Sure.
And we see it often, but hopefully if the plan is put in place and we help our clients do that, then you don't have to worry about jumping out and not knowing when to get back in.
Okay.
We always like to say stick to the process, or focus on the process, not so much focus on the short-term results.
Absolutely.
Right? So if our process is sound, then regardless of anything that happens in the short term, we know we're going to be okay because your plan is
hold steady.
Yep, absolutely, absolutely.
Well, Prashant, this next question is for you. It's actually from a caller in Odenton.
Okay.
And they want to know, what are the characteristics, the risk, and the benefits of the 2 types of investments, smart risk and smart safe?
So I like to characterize smart risk. That's kind of what we call it around our office. Smart risk is an investment where you know what your worst case scenario is. And for some clients, that number's different, right? So in some cases, smart risk might be only a risk of about 5% or a max risk of 10%. But anything that we know that we can manage to a target drawdown of maybe 5, 7, or 10% is what I would consider a smart risk plan.
Okay.
A smart safe plan is a plan where we put money in fully knowing that no matter what happens, we cannot lose one single solitary penny of what we put in.
Okay.
But when the market goes up, we may be able to participate in some of the upside. Now, we may not get a huge rate of growth on that, but we have the comfort of knowing that our money is 100% safe. And so I think most of our clients do a balance of smart risk plans and smart safe plans. And when we combine this together, that is really how we build a successful retirement plan. But I'm glad someone asked that, because that means our message of the smart safe and smart risk is really getting out there.
I love our viewer questions. They really are quite amazing.
Yeah, that's a good one.
So Nick, this caller actually is from Arnold, and they want to know, what are some keys to make certain your clients lock in lifetime retirement income?
Well, making the right decisions at the right time, sitting down again and putting together that plan and figuring out what is available to me that provides that lifetime income. So a pension is simply that, lifetime income. Social Security is lifetime income for you and your spouse as long as you're both alive. But there are plans out there that provide pension-like accounts with IRA money, with non-retirement money, that will provide secure lifetime income for them and their spouse. And not a lot of people know those exist. We talk about them every day because, again, our role as a firm is to focus on the distribution phase. And lifetime income is something that more and more people are concerned about. Pensions are not as readily available today as they were 20, 30 years ago. So there are ways to create your own type of pension without having to worry about living too long.
We just did a plan for somebody last week where they came in, they were both federal employees, spouses, and they had about $1 million. And what we did was we evaluated what we thought their expenses would look like in retirement. And all we did was we took about 30% of what they had at the thrift savings plan, and we created one of these self-funded pensions for them. And that gave them all the income that they think that they're going to need in retirement. So that other money, that other 70%, we were able to position it in a way where now it can grow to combat things like inflation for retirement.
That's fantastic.
Yeah.
Prashant, we have less than a minute left in the show this week. Can you tell the viewers one more time what they can expect to receive?
Sure. So when you call in, you'll be able to schedule a time to meet with Nick, myself, and our team of licensed fiduciaries. And when you meet with us, it'll be an opportunity for you to get to know us and us to get to know you. Ultimately, this process, our process, is all about you and helping you get on track for retirement. So you'll get the Social Security timing report, the income for life plan, as well as that complimentary review of your investments. The phone number is 833-308-5200 for the first 10 callers. So please give us a shout.
Prashant, thank you so much. Nick, thank you so much. Most of all, viewers, thank you for your amazing questions. We'll see you next week. Be safe, be happy, be blessed.